But with that, let's move on to our next guest of the show. We have market expert Sunil Subramaniam joining us. Sunil sir, good morning. So good to have you. FIIs have sold for 2 straight days now, and now we are seeing 30-year bond yields rising in the US, 40-year Japanese bond yields also rising to about 3.5%. So what does it mean for Indian markets, and especially with the FII flow picture going ahead?
I think that naturally the downgrade and the resultant yield moves could have done some equity versus debt allocation changes in FIIs broadly, because it's generally this is a signal for getting risk off the table. And any fresh allocation, like you said, 30-year US Treasury is at 5% plus, 10 years are at 4.5. So maybe there is some reallocation going out of the equities basket into the debt. But I think it's going to be a short-term phenomenon because it's just the trigger of the downgrade. I think it's a news which already was there in the pipeline. The other two rating agencies had already downgraded the US. It's just that sentimentally it's affected the market. Second is that I think the FIIs are also the hedge funds, I would say, those who moved into India in the last few weeks are probably booking profits. So it's just they're taking some healthy money off the table. I am confident that they will come back as they see. They're probably a little bit worried about valuations in specific pockets, which have run up a lot. They probably will re-enter as the market readjusts. I don't see this as any long-term negative trend from FIS on India.
Okay, okay. Sunil sir, you did mention about the earnings front as well, because now the earnings yield on the Nifty 50 that has fallen by about 64 basis points since the end of Feb. And if you look at the yield on 10-year bond yields, that have risen about 27 bips. So a negative spread can also act as a headwind for the sustainability of flows going ahead. Do you believe so?
Not really, because I think in Indian market, I don't think there's so much of a interaction between the debt and the equity. FIs are very flexible there. But I think Indian fund managers, if you have money for equity, you'll put it in equity. You have money for debt, you'll put it in debt. You have very limited flexibility to take equity money and put it in debt. So the Indian market, I don't think these yield gap differentials are generally shown to say that for investors to make an allocation, they are used to say that now, equity may give debt-like returns, so shift. But that's a very broad level thing. But the money in the market is heavily in favor of equities. Even last month, you saw about 25,000 crores fresh money coming into equities. This is apart from what came into the hybrid funds. So I don't see this, as far as India is concerned, this yield gap differential driving flows from equities into fixed income at all.
Okay. So, sir, what about the Japanese bond yields? Because if they continue to rise ahead, can we see a similar fallout of yen carry trade of last year?
So I think that's also slightly overdone, because see, what happens is that this yield going up. So if the Japanese investors, right, are looking at comparative markets, because Japan as an in-house investment destination, because of low interest rates, has always been not a preferred destination. Now, I believe that to the extent that people borrow money on the Japanese yen and use the carry trade here, the costs obviously are going up because of the yields going up. But my sense is that pure Japanese FII money is not leveraged money, because Japan is an export surplus country. They have enough surpluses there. It's players from other countries who tend to borrow in this currency war and get in and try to make money both on the currency and on the underlying stock markets. So there could be some shift in those kind of carry trade ventures. But I think from last time's time, there's already been a lot of readjustment happening, because the currencies all have moved very crazily since the last time we saw the yen trade collapse. So I don't think that in the recent past, with the Japanese yields already having risen, the carry trade is that big a part. Pure Japanese FII money is coming in, and I think dollar money is been coming in straight away. So the quantum of carry trade compared to last time is not as great. And so any readjustments there, I don't expect a major fallout on Indian equities.
Okay. So, sir, now that we're in a consolidation phase in the markets, what would you suggest for the investors? Is it a buy, sell, or a whole market at this point of time?
So I would say that if you have a year and a half outlook, it's a whole market. If you have a longer period than then, it's a buy market, because all the news around India is by and large positive. You have 100,000 crores of tax giveaways flowing into the system. You have an RBI dividend of around 2.5 to 3.5 lakh crores. flowing into the system through the government. You will have a rate cut coming in. You have the potential BTA signing happening sometime. So I don't think there's any negative news for people to sell in this market, right? The people who are going to be selling here are the short-term hedge funds from foreign who made a lot of money out of India. But as far as domestic investors are concerned, yes, if you have a shorter term outlook, the market's rally in the recent past has probably discounted a lot of the good news. We know that the earnings season guidance was not great. It is my belief that the actual earnings, when they come through in the coming quarters, will beat the guidance because the guidance were overly pessimistic because of the trade war overhang. So I think that the news will only get better and better as we flow through the quarters. But yes, today, because of the recent rally, which happened on the back of a relief on the Indo-Pak ceasefire, on the relief on the international front with Russia and Ukraine talking, that's what led to this rally. So probably a lot of the good news is in the price. So in the short term, if you're expecting very rapid gains, that may not be good, but I would suggest that you just hold it there because new good news either from the BTA or from the RBI rate cut would help the markets get a fresh leg up. So stay invested in that sense. But if you are a longer term investor, then it's a good idea to start buying into this market, especially days like yesterday, right? So buying on dips in a staggered way is a very good approach because I believe in the next 3 to 5 year time frame, Indian markets will give very good returns as this whole trade war scenario goes into the backseat and India's own whatever status as the fastest growing country with very good fiscal status dominates the play. So that's my suggestion. Either you hold for short term or you buy for the medium to long term.
Okay, okay. Sunil sir, you did mention that the earnings guidance has been quite pessimistic from going forward. So, would you recommend investors to reset their return expectations for a 2 to 3 year long-term horizon? Because in this consolidation period, also we can see that the valuations did become exorbitant, and that became a concerning point for the street going ahead.
I think you're right there. That's why I recommended a hold for people with a 1.5 year outlook because you're right that the valuations today seem rich. But like I said, that richness is coming because of the pessimistic guidances. Because these are all forward P's. It's not the trailing P's, right? But my sense is that if you go quarter on quarter, you'll find the valuations becoming more reasonable. Not because the market is going to be flat, but because the earnings are going to get upped in terms of the guidance in the next quarter and the following quarter. So I think that I'm not overly concerned from valuations unless you're a very short-term investor. Then it definitely looks very overvalued. From a medium-term perspective, I think the valuations are reasonable. And if you hang in there, I'm sure those returns would come through.
Okay, okay, okay. Ritin sir, everyone is talking about narrative stocks and the bloated valuations that the space presents. Would you also recommend investors to stay away from these narrative stocks, be it the likes of PSUs, capital goods, railways theme?
And defense you didn't mention, right?
Yes, of
So
course,
the
defense.
top narrative stock. So yes, see, the narratives play is a very hard one to really say because the narratives are good. The problem is that the price already reflects the narratives. And retail investors tend to follow the trend. So because these have been rising in the recent past, they go jump in there. So from a retail investor's perspective, I would say definitely you should exercise caution when you go into narratives because when the narratives come into the public domain, it's probably a bit too late in the day, right? So but however, I still say that the narratives are not on any weak ground. They are pretty strong grounds. For example, defense, as I mentioned, this Indo-Pak war has probably led to a reset in terms of at least 50,000 crores of additional order book. The narrative on defense is also supported by the fact that Europe is now going to be building their own arsenal because they can't rely on NATO. So they're going to be buying. And India's capabilities, the war, Indo-Pak war has shown our capabilities in modern technological warfare like UAVs and drones. So export order books are also likely to come. The third part of this narrative is that this has been focused largely on the PSU defense mechanisms, right? Companies. But there are a whole host of private sector companies which have been supplying all this to the Indian Defense Forces who would probably come into the market and list. So the space is going to expand. So I would say the narrative is pretty strong. Today's prices have taken the good news into account. So don't expect short-term gain. So if you're coming in with a short-term outlook, definitely you're taking a high risk, high reward bet. That's based on your risk capital. You want to take that. But if you have a medium-term outlook, I still feel that the narratives will deliver returns. So I don't say that these narratives are on any weak ground. To me, all of those sections that you mentioned, right, especially railways, the infra play, all of these, I think, are going to be good stories to hold for where the government support will continue. So, like I said, again, short term, it's a high risk, but in the medium term, I would say it's worth holding.
Okay, okay. Sunil sir, I want your view on the IT sector also, because given the Moody's downgrade that we saw, so everyone is a little cautious about the export-oriented theme. Also, yesterday we saw that the Nomura has given out, they did meet the CFO of Infosys, and they said that the revenue growth guidance for FY26 is about 0.0 to about 3% in constant currency terms, while the street was already working with about 3 to or 4% in constant currency terms. So, what would you suggest for IT sector as a whole going ahead?
Actually, I've changed my mind a bit about IT. I now more feel that it's a buy on dips because I feel that the correction is a bit overdone, and I see that the downgrade of America as a credit, I don't think is going to affect American corporates in terms of their business plans. So, if the America-China trade talks go well and they come to a reasonable conclusion by the end of the 90-day period, if India's BTA with UK, US comes well. They've already done a UK BTA, America. So I think that the tariff related uncertainty, if that goes away, and we know clearly that, okay, with China it's going to be 15%, India is going to be 20%, whatever it is, that going away of the uncertainty is a big relief to American corporates. They can make their plans. And I think IT will be a big part because in this ever changing world of AI, they need IT consulting even more. So my view is that the sentimental correction that's happened in IT because of this, right? I think it's a bit overdone. And I believe that if IT would be a buy on dips for me, because I believe that when FIS consistently invest in India, IT is one of their favorite sectors. And so we should also be buying something that will be bought by your big ticket players, which will be IT. So my view there, I was a bit negative a few months ago, but I'm now changing to say that it's good to accumulate IT on dips.
Okay, okay. Since you mentioned that now that the FIs are buying, so they'll be favorable towards the IT sector also. What about the banking space? Do you believe that the run-up that we have seen in the past a couple of months is already quite overdone compared to how the March quarter performance fared out?
Yes, in the way that you framed it, that related to the March quarter performance, yes, it looks like that. But I would still say that that's the most positive sector still in the market. So that has been already recognized. That's been the rally, right? Because you have the RBI rate cut, low inflation, money in the hands of the middle class, a good monsoon putting money in the hands of rural India. So broad-based consumption rally, realty will also rally, auto will also rally. So big banks are ideally positioned to capture this. But my focus there would still be on private sector banks because not only this boom I see in the immediate future is going to be more of a retail middle class boom where now the private sector is far better geared on a quick turnaround, quickly passing on the rate cut benefits and taking advantage. Plus, the private sector also benefits because most of the large private sector banks are also very, very good distributors of mutual funds and portfolio management and insurance and all of that. So this 100,000 crores of cash is not going to go all into consumption. A lot of it will be diverted into savings. And I think equities you've seen that through all of this volatility, our SIP book has remained rock solid. So with now these things easing a bit, I see the SIP book growing and I think the benefits of distribution income to these banks will also kick in. There might be some NIM pressure in the near term because when you have a rate cut, right, depending on how fast you can cut deposit rates versus lending rates, and there I feel that again private sector banks have a slight advantage because all their auto loans and their personal loans are fixed rate loans. So any drop in their deposit rates will improve their NIMs on that perspective. Where they'll probably suffer is in lending to the high-end corporates who will get their pound of flesh in the housing loan sector, which is very competitive and probably on a more floating rate basis. So I would still back the private sector, despite the run-up that's happened, to deliver good quality earnings growth, right? Because even any small compression in NIMs would be compensated by a growth in the loan book. So I think they will come out. PSU banks might get a little bit of a hit initially, but over the medium term, they will also come back on because this consumption boom should lead to a capex drive in the private sector, maybe in about a year and a half. So, from a medium term perspective, PSU banks also are reasonably okay. But to me, the private sector financial institutions, I would say, are still worth a bet on given how the economic scenario is going to pan out over the next 6 months.
Okay. All right. All right. With that, we have to let you go, Sunil sir. But thank you so much for your time, and we hope that we connect with you soon. Always an insightful conversation with you.